Picture this, you're 17 years old. Everyone around you, your parents, your teachers, your guidance counselor, is telling you the same thing. Go to college, get a degree. It's the key to a better life. It's how you build a future. So you apply, you get in, you're proud. And then someone slides a piece of paper across the desk and asks you to sign for $30,000, $50,000, maybe $100,000 in loans. Money you've never seen, for a future you haven't yet lived. At an age when you can't legally buy a beer, you sign because everyone told you to, because the system was built to make this feel like the only choice. Fast forward 10, 15, 20 years. You have a degree, maybe a decent job, but you also have a debt that has followed you like a shadow through your 20s, your 30s, sometimes your 40s and beyond. A debt that can't be discharged in bankruptcy, that can garnish your wages, that can seize your tax refund. Today, Americans collectively owe $1.8 trillion in student loan debt, spread across nearly 43 million borrowers, and every 9 seconds, right now, as you watch this, another American falls into default. In 2006, total student loan debt stood at roughly $481 billion. By 2012, it had doubled. Since 2007 alone, federal student loan debt has increased by more than 217%. The average balance per borrower today is $39,633, a record high, and 3.6 million borrowers owe over $100,000, a figure that has grown by more than 1 million people since 2018. In 2025, 24% of borrowers with payments due are behind on those payments, nearly 1 in 4. The delinquency rate shot from 0.53% in late 2024 to 9.57% by end of 2025, an 18-fold increase in a single year. And in just the first year of the current administration, 3.6 million new borrowers fell into default. $92 billion in student loans defaulted in 2025 alone. The story starts in 1965 with the Higher Education Act, landmark legislation that created the federal student loan program. The vision was genuinely noble. Make college accessible to every American, regardless of their family's wealth, by guaranteeing loans that private banks would issue to students. It worked. College enrollment surged. In 1972, President Nixon created the Student Loan Marketing Association, what the world came to call Sally Me. Sally Me was a government-sponsored enterprise whose purpose was to buy student loans from banks, freeing those banks to issue more loans. But there was a flaw built into the system from the start. When the government guarantees a loan, the lender has no real incentive to be careful. The risk had been transferred from the lender to the borrower. When the federal government makes it easier for students to borrow money, colleges have a powerful incentive to raise their prices, because students can always borrow more. Since 1980, college tuition and fees have increased by 1,200%. Over the same period, overall inflation rose just 236%. College costs have risen at 5.8% per year since 1983, nearly twice as fast as medical costs, 4 times faster than home prices. In 1997, Sally Me began privatizing. By 2004, its federal charter was terminated. It became a fully private, publicly traded corporation, accountable not to students or taxpayers, but to shareholders. Sally Me's stock rose 19% between 1995 and the mid-2000s. It expanded aggressively, acquiring competitors, establishing a bank, building a stake in nearly every aspect of the industry. Origination, servicing, collections. A company that originates your loan, services your loan, and collects on your loan when you default has more incentive for you to struggle than to pay it off cleanly. A borrower in distress is not a failed customer. They are a revenue stream. Sally Me pushed borrowers into forbearance, where interest compounds, rather than repayment plans that might have kept them current. Sally Me spent $16 million on federal lobbying between 2008 and 2012, with 63 registered lobbyists across 9 states. This influence successfully blocked student loan reform for years, protecting an industry structure that was systematically failing millions of borrowers. Then in 2014, Sally Me split into 2 companies. The consumer bank kept the name. The loan servicing giant became Navient. In 2022, Navient agreed to cancel $1.7 billion in private student loan debt for 66,000 borrowers and pay $95 million in restitution to 350,000 federal loan borrowers, after state attorneys general accused it of steering borrowers into costly forbearance, misapplying payments, and misleading borrowers about their options. The same company built to help students had spent years systematically keeping them trapped. The student debt crisis does not fall equally on all Americans. Black borrowers carry disproportionately higher debt at every level. Black women hold 43% more undergraduate debt and nearly 99% more graduate school debt than their white female counterparts just 12 months after graduation. 36% of black adults carry student loan debt, compared to 20% of white adults. 52% of federal student loan borrowers are over the age of 35, 20% are over 50. Borrowers aged 35 to 49, people who should be in their peak earning years, saving for retirement, collectively owe $681.5 billion. And the Parent Plus loans account for $110 billion in outstanding debt. This is student debt affecting not just students, but their parents, entire generations simultaneously. Consider what this debt delays or destroys. A person spending $400 a month on student loan payments has $400 less for a down payment savings account, $400 less for retirement contributions, $400 less for starting a business, $400 less for building the kind of financial foundation that compounds over a lifetime. The housing connection is direct. Student loan debt is one of the leading reasons millennials and Gen Z delay or forgo homeownership entirely. And there is one feature of student loan debt that makes it uniquely punishing. You cannot discharge student loans in bankruptcy. Credit card debt, medical debt, business loans, even casino gambling debts, all can be discharged. Student loans cannot. This legal carve-out, which did not exist before 1976, was lobbied for by the lending industry specifically to protect their asset. It transformed student debt from a financial instrument into something closer to an inescapable obligation. What would actually help? First, restoring the ability to discharge student loans in bankruptcy, forcing lenders to price risk honestly. Second, attacking the supply side. States need to restore funding to public universities. Congress needs to tie federal loan eligibility to institutional accountability. Third, making income-driven repayment automatic, real enrollment, real adjustment, real forgiveness at the end of a defined period. None of these are simple. All face fierce resistance from the industries that profit from the current system. $1.8 trillion in debt, 43 million borrowers, a new default every 9 seconds, parents in their 50s still paying for their children's college loans. Borrowers in their 40s unable to buy homes because of debt they took on at 18. This did not happen because Americans are bad at managing money. It happened because a system designed to open the doors of higher education was captured, slowly, methodically, by the financial interests of lenders, servicers, and institutions whose profits depend on keeping those doors expensive. Understanding that is the first step. If this video gave you a clearer picture, share it with someone who needs to see it. Subscribe for a new documentary every week. Next week, we're going to show you how credit card companies turn your financial stress into their biggest profit center and why the interest rate on your card is not an accident. We'll see you then.